If you're a Canadian home buyer or homeowner, I'm going to say something that might annoy you. One of the biggest rate wildcards in Canada for 2026 isn't the Bank of Canada, it's the United States. Because in a recent announcement, President Trump made a move that basically equals out to being an economic experiment. He directed Fannie Mae and Freddie Mac to buy $200 billion in mortgage bonds. Now, this doesn't build houses, this doesn't help with down payments. It's the government stepping in to buy mortgage debt at scale to push mortgage rates even lower and push them down. And here's the part Canadians can't ignore. When U.S. mortgage markets shift, Canadian fixed mortgage rates often feel it, sometimes very quickly. So in this video, I'm going to break down the three things. 1, what the U.S. just did in plain English. 2, how it can ripple into Canada and our mortgage rates as well. And 3, why the good news could get canceled out by the bigger risks settling in beside it. Right now, as I'm sure you've seen, housing feels like a stalemate. Buyers are waiting because payments still feel heavy. Sellers are waiting because they don't want to give it away and they want to sell their house for what they believe it's worth. And homeowners are watching renewals coming up thinking, okay, what's my payment going to be next? So when the US president effectively says, we're going to try and push mortgage rates down by buying mortgage bonds, is not just a US headline. It's something that can leak into our market, especially on our fixed mortgage rates. Here's the simplest way to understand it. In the United States, most mortgages don't just sit quietly on the bank's books for 25 years like we all might imagine. They get packaged into mortgage bonds and basically bundled together to be sold off to investors. Investors buying those bonds is what helps set mortgage rates. More demand for mortgage bonds generally equals out to being lower rates for borrowers. Now reports are saying that Trump ordered his representatives overseeing Fannie Mae and Freddie Mac to buy up $200 billion in mortgage bonds. So why do this? Why does this matter? Because it's a giant new buyer entering the market. It's like showing up to Costco and finding one customer just bought the entire pallet of what you're looking for. That kind of demand can change pricing dramatically. And we've already seen early movement. Reports say that U.S. mortgage rates fell to around 6.06%, the lowest they've been since September of 2022. And they've connected that directly to the administration's bond buying push. Now, does this guarantee anything? No, absolutely not. But it tells us the market is taking the policy very seriously, and it's something we should pay attention to. Now, I know you're probably sitting there going, okay, Myles, cool story, but we live in Canada, and that's fair, but I'm going to give you the 3 bridges that connect this to Canada, and of course, trying to do it without getting too deep into the weeds and talking a bunch of jargon. The first one is the bond market bridge, and this one's big for fixed rates. In Canada, fixed mortgage rates are heavily influenced by Government of Canada bond yields, especially around the 5-year range. And Canadian bonds don't live in a bubble. Global investors compare US and Canadian yields all the time. So if US mortgage bond buying pushes yields lower in the United States, it can pull on Canada's yields too. And that can flow into Canadian fixed mortgage rates. Not perfectly or instantly or every time, but the connection is real and it's there, and it's something we need to look at. The second thing is the confidence bridge. Markets don't just move on math, they move on certainty. One reason people freeze is uncertainty. Should I wait? Will rates drop again? When policy signals we're trying to lower rates, it can change borrowers' psychology and investors' positioning. And even if you don't care about US politics, your mortgage rate can still be affected by the investor behavior reacting to US policies. And the third one is the renewal bridge. Canada has a huge renewal wave that's still moving through the system, and even small moves in rates matter. A tiny reduction doesn't change someone's life overnight, but across hundreds of thousands of renewals, it could be meaningful. So yes, Canadians should pay attention to this information, and they should pay attention to what it's going to do to interest rates. Here's where the story gets complicated and, to be honest, way more important. The US can create downward pressure on mortgage rates, but upward pressure on inflation all at the exact same time. BC's government timeline notes the US raised tariffs on Canadian goods not covered by the CUMSA from 25 to 35%, with trade talks ongoing. And RBC Capital Markets similarly discussed 35% tariffs on Canadian goods traded outside the CUSMA. But why does this matter for mortgages? Because inflation pressure can keep rates higher for longer, or at least limit how far they can drop. So we get this weird tug of war. Bond buying pushes mortgage rates down, tariff and trade uncertainty can push costs up and keep inflation sticky. And Canada sits right there in the middle of it. Now, people have been asking, why doesn't Canada just do this too? We do have a mechanism that bundles insured mortgages, and that's Canadian mortgage bonds through CMHC's related securitization. But the structure is different than the United States mortgage machine. In Canada, a lot of mortgages are held by lenders on their own books. The insured securitized channel is important, but it's not the entire market. The other thing is that scale matters. The United States mortgage market is enormous, and their mortgage bond market is built on this kind of intervention. So could Canada attempt something similar? Technically, governments can intervene in markets, but the bigger question is, would it work cleanly without causing other problems? And honestly, Canada doesn't necessarily need to copy this move to benefit from it. If US bond buying lowers yields broadly, Canada can get some of the spillover without spending billions of dollars. Here's the practical takeaway from this. The headline does not mean rates are about to crash, you should rush and buy, or everything is going to be cheaper in 6 months. What it does mean is mortgage rates are influenced by global factors, not just Canadian headlines. So if you're buying or renewing in 2026, the best move isn't to become a political analyst. The best move is to become prepared. And the best way to be prepared is a simple 3-check checklist. 1, cash flow ready. Can you handle payments comfortably without a buffer? 2, plan ready. Are you staying long enough that short-term noise doesn't matter to you? And then, of course, being ready for stress. Will you sleep at night if the market doesn't do what the internet promised or what you think it's going to do? That's how you win in markets driven by uncertainty. You don't guess or throw crap at the wall to see what sticks. You create a plan and you follow it. And you really try to identify your comfort levels and how you're going to be able to handle the entire thing of owning a house. So, in short, yes, Trump's $200 billion mortgage bond move is a big deal in the United States. And yes, it can ripple into Canada through bonds, confidence, and renewals. But the real story isn't what will the rates do next. The real story is, in 2026, the advantage won't go to the people who guess right. It'll go to the people who are prepared. Now, if you want, I can help you run your own numbers. Not a sales pitch, just a reality check. What payment range are you comfortable with? What buffer do you need? And what kind of mortgage structure fits your risk tolerance? And if you want more Canadian First breakdowns like this, no hype, just clarity, hit that subscribe button down below and let me know if you have any questions in the comments. My name is Myles Nowik of the Nowik Mortgage Team, powered by Indy Mortgage. Thanks so much for watching. We'll catch you on the next one.